Welcome! This is Jaguar Consultancy, and we're going to be taking you through a deep dive into Chevron's place in the oil and gas industry, along with key players like ExxonMobil and Shell. Sit back, relax, and enjoy this external analysis. Today, we're looking at the three companies that dominate the global energy landscape. Chevron anchors our analysis as a highly focused upstream powerhouse that efficiently produces 4 million barrels of oil per day. Its rival, ExxonMobil, is the undisputed heavyweight of the group, dominating the sector with a massive $448.9 billion asset base and an industry-leading 8.9% profit margin. Finally, Shell stands out as a diversified giant, leveraging its $393 billion in assets to command the LNG market and operate an unparalleled global retail network. To understand their strategies, we first look at their structural foundation. In 2025, ExxonMobil maintained the most expansive corporate footprint, with a total asset base of $448.9 billion, structurally outscaling both Shell's $393.2 billion and Chevron's $324 billion. This divergence reflects ExxonMobil's aggressive expansion in core extraction regions like the Permian Basin, contrasting with Shell's strategic asset divestments to fund its energy transition. Prioritizing short-term liquidity, Shell held the largest pool of current assets in 2025 at $114.2 billion, significantly surpassing ExxonMobil's $83.3 billion and Chevron's $38.5 billion. Shell deliberately maintains this elevated cash buffer to safely finance its capital-intensive pivot toward integrated power and renewables while managing its highly active trading arm. Reflecting the highly capital-intensive nature of this industry, ExxonMobil led long-term infrastructural investments with $365.5 billion in non-current assets, followed by Chevron at $285.4 billion and Shell at $279 billion. These massive long-term investments are required because ExxonMobil and Chevron rely on complex offshore rigs and heavy refining infrastructure as their primary profit engines. Concluding the 2025 fiscal year, Shell carried the highest aggregate obligations at $218.8 billion, whereas Chevron maintained the most constrained liability burden at $131.8 billion. Shell's higher liability profile is a byproduct of its highly diversified global operations and trading requirements, while Chevron operates a leaner, highly focused upstream extraction model to minimize debt. Leveraging its massive scale to compound shareholder value, ExxonMobil established a fortress-like equity position of $259.3 billion in 2025, substantially eclipsing Chevron's $186.4 billion and Shell's $174.3 billion. By retaining and aggressively reinvesting the record profits generated during the 2022 supply crunch, ExxonMobil has structurally lowered its cost of capital relative to its peers. Normalizing from the macroeconomic peaks of 2022, ExxonMobil sustained its top-line market dominance through 2025 by generating $323.9 billion in total revenue, remaining ahead of Shell's $284.5 billion and Chevron's $189 billion. ExxonMobil's revenue resilience is fueled by unmatched production volumes across both its upstream extraction and massive downstream chemical and fuel manufacturing divisions. ExxonMobil generated an absolute net profit of $28.8 billion in 2025, easily outpacing the $18.1 billion from Shell and the $12.2 billion from Chevron. This absolute profit dominance is directly attributable to ExxonMobil's massive extraction operations in high-yield regions, insulating it better than Shell, whose chemical division was significantly underperforming this past year. ExxonMobil proved most adept at converting top-line sales into bottom-line earnings, securing an 8.9% net profit margin over Chevron's 6.51% and Shell's 6.4%. ExxonMobil achieved this margin through strict cost controls and highly profitable specialty products, whereas Chevron's heavy reliance on crude oil extraction makes its margins more susceptible to market price drops. All three supermajors demonstrated robust short-term solvency with current ratios reliably above 1.0, though Shell concluded 2025 with a slight liquidity advantage at 1.22 compared to 1.15 for both ExxonMobil and Chevron. This metric confirms that despite extreme market volatility, all three firms actively retain ample working capital to comfortably satisfy their immediate operational debts. Shell maintained the strongest position in 2025 with a quick ratio of 0.98, outperforming ExxonMobil's 0.79 and Chevron's 0.73. Shell requires this stricter inventory-independent liquidity to swiftly navigate and capitalize on the rapid pricing fluctuations inherent in its massive global energy trading operations. ExxonMobil achieved the most conservative capital capital structure by 2025 with a debt-to-equity ratio of 0.17, while Shell carried the highest relative financial leverage at 0.43. ExxonMobil systematically directed its recent cash windfalls toward retiring long-term debt, minimizing its financial risk profile far more aggressively than its European counterpart. ExxonMobil extracted the greatest proportional yield from its corporate resources in 2025, recording a 6.4% return on assets that exceeded Shell's 4.6% and Chevron's 3.8%. This indicates that ExxonMobil's core infrastructural assets, from offshore wells to refineries, are currently operating closer to peak efficiency, generating more profit per dollar of capital deployed. Delivering the highest relative value to its shareholders in 2025, ExxonMobil sustained a sector-leading return on equity of 11.1%, narrowly edging out Shell's 10.4% and noticeably outperforming Chevron's 6.6%. By combining low financial leverage with superior profit margins, ExxonMobil ensures that the capital actively invested by its shareholders is generating the maximum possible return. Now moving on to the value chain analysis of Chevron and how it compares to its industry rivals. At a high level, all three firms operate fully integrated oil and gas value chains. However, the key differences lie in how each firm creates value, whether through cost efficiency, scale, or strategic positioning toward the energy transition. Here's a quick VCA from the previous internal analysis video. Starting with a firm infrastructure, Chevron emphasizes governance, capital discipline, and ESG compliance, which supports its consistent dividend and acquisition strategy. In contrast, ExxonMobil is more integration-driven, maximizing returns through scale and high return on capital employed, while Shell focuses on a more flexible, transition-oriented structure centered on LNG and energy solutions. For human resources, Chevron relies on a technically skilled engineering workforce to support upstream execution. ExxonMobil leans heavily into engineering expertise and safety culture for large-scale operations, while Shell differentiates itself through a more global and adaptable workforce, particularly in LNG trading and transition-focused reskilling. In terms of technology, Chevron focuses on AI-driven drilling and carbon capture technologies. ExxonMobil emphasizes advanced seismic and enhanced recovery technologies to maximize output, while Shell prioritizes LNG optimization and low-carbon innovations to support its transition strategy. For procurement, Chevron uses global sourcing to maintain cost efficiency. ExxonMobil leverages scale to secure supplier advantages, while Shell integrates procurement with trading and LNG contracts, allowing better flexibility and risk management in volatile markets. In inbound logistics, Chevron sources from global reserves like the Permian and Guyana, supported by pipeline systems. ExxonMobil strengthens this with fully integrated internal logistics, while Shell differentiates through diversified LNG sourcing and flexible shipping networks. For operations, Chevron focuses on cost-efficient production across exploration, refining, and petrochemicals. ExxonMobil emphasizes scale and full integration, while Shell aligns operations towards LNG and energy solutions, reflecting its transition strategy. In outbound logistics, both Chevron and ExxonMobil rely on global pipeline and refining networks to ensure distribution efficiency. Shell, however, leverages LNG shipping and trading networks, allowing it to redirect supply based on market demand. For marketing and sales, Chevron and ExxonMobil focus on B2B contracts and fuel branding to stabilize revenue. Shell expands further into energy solutions and EV charging, signaling a shift toward a broader energy market. Finally, in after-sales, Chevron and ExxonMobil provide industrial support and lubrication services. Shell again differentiates by offering integrated energy services, including EV charging and fleet solutions, strengthening long-term customer relationships. After understanding how value is created, we now look at how each firm competes strategically across corporate, business unit, and functional levels. At the corporate level, Chevron follows a grow and return strategy, focusing on high-return upstream assets like the Permian and LNG, while maintaining strong dividends. ExxonMobil's priority is scale and cost leadership, expanding production in key basins like Guyana while leveraging full integration. Meanwhile, Shell is shifting towards LNG and integrated energy, reducing reliance on oil and focusing on long-term energy transition opportunities. At the business unit level, Chevron is focused on upstream growth and downstream optimization, with selective investments in carbon capture and hydrogen. ExxonMobil strengthens its position through high-output upstream projects and integrated refining and chemical operations. Shell differentiates by prioritizing LNG, energy trading, and renewable-related solutions, expanding beyond traditional oil and gas. At the functional level, Chevron focuses on efficiency, using AI in drilling and maintaining low cost per barrel operations. ExxonMobil emphasizes large-scale project execution and advanced R&D, particularly in carbon capture and recovery technologies. Shell focuses on operational flexibility, combining LNG operations with trading and expanding into customer-facing energy solutions. Looking at resources and capabilities, facilities, we use the VRIO framework. The focus is on whether each firm's assets are valuable, rare, inimitable, and properly organized in order to explain differences in long-term industry positioning under energy transition and oil price volatility. Chevron's only sustained advantage is its Tengiz joint venture because it's contractually locked, geopolitically embedded, and difficult for competitors to access or replicate. Its Permian Basin production is only temporary since shale efficiency is widely shared among U.S. competitors. Its capital strength is parity because all super majors have similar financial capacity. Its refining advantage is also temporary since refinery configurations can be replicated. Its Guyana stake is valuable but not fully organized, so it does not yet generate full competitive advantage. ExxonMobil's strongest sustained advantage is its Guyana operatorship because it controls development, timing, and cost in a uniquely high-quality basin. Its integrated refining and chemical system is also sustained as it captures value across the full hydrocarbon chain at an unmatched scale. Its deepwater engineering capability supports sustained advantage through proprietary technical expertise. However, its financial strength and Permian expansion are only temporary because they depend on capital and not uniqueness. Shell's sustained advantages are its global LNG value chain and energy trading platform, both of which are difficult to replicate due to infrastructure integration and proprietary market intelligence. Its EV charging and deepwater capabilities are temporary, since competitors can replicate them with investment and similar technology. Its refining network is parity, because all super majors operate similar downstream systems. Now we move on to a comparative company critique of Chevron, ExxonMobil, and Shell to evaluate their strategic positioning. Chevron's advantage comes from efficient U.S. shale production at about 3.3 million barrels of oil equivalent per day in 2024, supported by strong capital discipline that stabilizes cash flow but limits differentiation. Its integrated operations provide resilience, but its reserves have declined to around 9.8 billion barrels of oil, showing depletion pressure. Strategically, it remains exposed to oil price swings while growth depends on LNG and shale flexibility. Its Guyana exposure has future value but is still uncertain in execution and control. ExxonMobil's core strength is its unmatched financial scale, low-cost upstream assets in Guyana and Permian, and strong vertical integration across refining and chemicals. Its weaknesses include high capital intensity, complex integration from acquisitions, and sensitivity to downstream margins. Its growth opportunities are driven by scaling advantage assets for production leadership and expanding low-carbon technologies such as carbon capture and hydrogen. However, it faces significant threats from regulatory scrutiny, energy transition risks, and climate litigation that may affect its long-term operating environment. Shell competes through LNG leadership and trading, supported by about 9.6 billion barrels of oil reserves, making it more flexible in volatile markets. However, weaker reserve replacement and shifting strategy reduce consistency. Its strength is in capturing LNG demand and trading margins, but this comes with higher earnings volatility and regulatory pressure from its diversified model. Now we move further into the industry analysis, starting off with a pestle analysis. For the oil and gas industry's political and legal factors, the easing of Venezuela's sanctions creates an opportunity to increase global oil supply, while tensions between the US and Iran remain a major threat, especially in the Strait of Hormuz. In addition, OPEC production policies and ongoing Russia sanctions influence how much oil is available in the market. On the regulatory side, stricter policies such as California refining regulations, EPA methane and flaring rules, SEC climate disclosures, and EU environmental laws increase compliance costs. However, policies like the Inflation Reduction Act also provide incentives for cleaner technologies, creating both pressure and opportunity for the industry. From an economic perspective, the industry is highly sensitive to global oil price volatility, which creates cycles of high profits and sudden downturns. Regions like Permian Basin maintain a strong cost advantage due to lower production costs, making them more resilient during price drops. However, inflation and exchange rate fluctuations increase operating expenses, while higher interest rates make large-scale energy projects more expensive to finance. At the same time, demand uncertainty driven by the global energy transition makes long-term investment decisions more complex. Looking at social factors, changing consumer preferences or reducing reliance on fossil fuels, particularly with the increasing adoption of electric vehicles. The industry also faces workforce challenges as younger generations tend to prefer careers in renewable energy sectors. In addition, energy justice concerns and community resistance to make large infrastructure projects such as pipelines make it more difficult to expand operations. In terms of technology, advancements such as AI-driven shale extraction have significantly improved efficiency and reduced costs. At the same time, innovations like carbon capture and storage, green hydrogen, and advanced biofuels offer pathways for the industry to transition toward cleaner energy. However, the rapid development of renewable energy and battery technologies poses a long-term threat by reducing dependence on oil and gas. Environmental factors continue to put pressure on the industry to evolve. Companies are increasing investments in cleaner energy and setting net zero targets for 2050. Despite this, risks such as stranded assets, water scarcity in key production areas, and stricter flaring regulations remain major challenges. Now we move to Porter's 5 forces. this. The oil and gas industry experiences high competitive rivalry, mainly because it's dominated by a few large players, along with national oil companies. This creates an oligopolistic structure where firms compete more on access to reserves, such as the Permian Basin or Guyana, rather than engaging in price wars. In addition, OPEC plays a key role in controlling supply, encouraging firms to prioritize stable returns over aggressive market share expansion. Recent consolidation in the industry has also reduced the number of smaller competitors, further intensifying rivalry among the remaining major players. Looking at buyer power, it's considered moderate. The main buyers include refiners, airlines, shipping companies, and governments. Since oil is a standardized commodity, there's limited product differentiation, which gives buyers some negotiating power. Large buyers, such as major Asian refiners, can secure volume discounts. However, this power is balanced by the fact that there are limited substitutes for key products like jet fuel and petrochemicals in the medium term, preventing buyer power from becoming too strong. The threat of new entrants is low to moderate due to massive capital requirements and lengthy development timelines. While shale offers lower entry barriers, established firms control the best land and low-cost reserves. Furthermore, high interest rates currently hinder financing for new players, reinforcing the dominance of incumbents. Meanwhile, the threat of substitutes is moderate to high. Electric vehicles and renewables are aggressively displacing gasoline and natural gas in developed markets, while biofuels and hydrogen continue to emerge. However, oil remains critical for aviation, shipping, and petrochemicals, where viable large-scale alternatives are currently limited. Finally, supplier power is moderate. Oilfield service companies have some influence due to specialized technology and expertise. However, large oil firms maintain negotiating power because of their scale and long-term contracts. This helps stabilize costs and reduce supplier influence. Now we move to the strategic group map. We start with ExxonMobil, which sits at the extreme top right, reflecting both the largest scale, around 3.7 million barrels of oil per day, and the highest level of vertical integration. It controls the full value chain from upstream production to refining, petrochemicals, and retail, allowing it to maximize value capture and stabilize earnings. Chevron is also in the upper right quadrant, but slightly below ExxonMobil, reflecting strong integration but a somewhat smaller scale. Its downstream footprint is leaner, signaling a more selective and efficiency-driven integration strategy. Shell remains in the upper right quadrant, but sits below both ExxonMobil and Chevron in scale. Despite this, it maintains very strong integration, particularly through refining, LNG, and global trading operations. ExxonMobil is positioned in the upper left quadrant, showing very high dependence on upstream oil and gas, with relatively limited diversification into energy transition. While it invests in carbon capture and hydrogen, its strategy remains focused on strengthening its core fossil fuel business. Chevron aligns closely with ExxonMobil in the upper left quadrant, indicating very high upstream dependence and moderate low diversification. However, it is slightly more diversified with growing investments in biofuels, hydrogen, and carbon capture. Shell shifts to the lower right quadrant, highlighting lower upstream dependence and very high diversification. It is a leader in LNG, renewables, power markets, and EV infrastructure, reflecting a clear transition toward a broader energy model. ExxonMobil again leads in the top right, combining very high cost efficiency with strong portfolio diversification across oil, gas, and chemicals. This makes it one of the most resilient players, capable of performing well across different market cycles. Chevron stands out for its very high cost efficiency, driven by its focus on low-cost, high-return assets like the Permian Basin. However, its diversification is more moderate, placing it slightly left of ExxonMobil. Shell appears in the mid-right area with high diversification but only moderate cost efficiency. This is due to the complexity and cost of managing a broader and more transition-focused portfolio. Now we look into the future key success factors. First, Chevron must maintain strong cost discipline and operational agility to stay profitable despite oil price volatility. It must reduce operating costs through digital technologies, focus on short-cycle, high-return projects, and use AI to optimize operations in real time. Second, Chevron needs to optimize its upstream portfolio by focusing on low-cost, high-return assets like the Permian Basin. This includes improving recovery using advanced technologies, expanding core assets, pursuing selective acquisitions, and divesting underperforming fields. Third, LNG is a major growth opportunity as demand for cleaner energy rises globally. Chevron should secure long-term LNG contracts, expand capacity in existing projects, and invest in lower-emission LNG solutions. Fourth, Chevron must invest in decarbonization technologies to remain competitive in a low-carbon future. This involves scaling carbon capture projects, expanding hydrogen biofuels, and setting clear emissions reduction targets. Fifth, maintaining financial strength is essential in a capital-intensive industry. Chevron should keep low debt levels, prioritize high-return investments, and balance shareholder returns with reinvestment. Finally, ESG and regulatory management is critical for long-term sustainability. Chevron must ensure compliance, improve emissions transparency, engage stakeholders, and invest in reducing its environmental impact. And that is the end of our external analysis for Chevron. This is Jaguar Consultancy.